All right. Good morning, everyone. It is 8:45 in the morning of March 30th, 2022, and this is my pre-market strategy session. Quite a bear market rally here, and these are the only time you see rallies like this is when we're in a bear market or we're headed into a blow off top. The end. When you see things, the larger indices move in the way that they've moved over the past 2 weeks, it is either a bear market rally or a blow off top. So here we have the SPY. It has moved up 11.13% in the last 2 weeks. We'll call it. The Qs moved up 17% in the last 2 weeks. These are all short squeezes. The IWM has moved up 10.62%. Tesla, oh my gosh, Tesla has run up 47.45% in the last 2 weeks. 47.5% in 2 weeks on a stock price on a stock that was at roughly $765. Incredible. Amazon up 20%, 21.26%. Let's see, USO, I'm not really. XLY, 18% from the 14th to yesterday. Are we due for a pullback? Yeah, way overdue, way overbought right here. Doesn't mean it has to happen, just means that we're due for one. So this morning, it does look like we're getting a little bit of a pullback this morning, but I don't really think it's anything to get too excited about yet. If things really start to reverse from here and fall down from here, then we'll look back and say, hey, this is the end of that short squeeze that happened. Until then, though, it's still time to be cautious. It's always time to be cautious. Average into a trade and just kind of let this thing develop. If this turns out to be the top of the short squeeze, and now we're headed for the next leg down, there's time. I think that we'll be able to move on this thing a little bit. We don't have to be aggressive. We can move on it slowly. Check out this indicator. This is the 10-year minus the 2-year. So right now in the yield. So the 10-year yield minus the 2-year yield. And so right now there's a 0.05% difference between what you can get for a yield on the 10-year and the 2-year. So that means if you put your money in one place for 10 years, it'll yield you roughly the same as if you put it in, lock your money away for 2 years. Now, I don't know anybody who would put their money in the 10-year and lock their money up for 10 years at roughly the same rate. You can lock your money up for 2 years, especially because if rates start running a lot higher and you're in the 10-year, you've got to just sit through that entire episode, all that pain of watching your bond valuations hit the dirt, and at least if you have your money locked up into a 2-year, you can sell them on the market either way. You can sell these things on the market either way, or you're going to get punished. I don't know who's buying bonds right now at all anyway. But they are. Somebody is. For yields, I think yields are actually going up. So let me see. Let's see here. Let's look at the large caps and stuff where I have my yields. Okay, so here's the 10-year. Yep. Bonds are still going up, and then here's the 2-year, which is going up faster. So, now people, this means that with bond yields spiking up like this means that yields have to go higher in order to attract more people to buying bonds. Yields heading up, and the yield curve really tightening. It's tightened. essentially, what's the difference between? I mean, I guess technically speaking, 0.056 is greater than zero, so technically it hasn't inverted yet. Although yesterday, if I remember correctly, let's go back here. Yesterday on the 1 minute, it did invert at one point yesterday, or it hit zero. Yeah, here it is, right here. It actually did hit zero yesterday. Yeah, the low right here, the low is zero. So the yield on the 10-year and the 2-year yesterday for a very short amount of time, this is about 1:30 yesterday in the afternoon, Eastern time, it hit zero. So the 10-year and the 2-year were yielding the same. So it obviously caught a little bit of a bounce right there, sort of a, just sort of a, if there are people who are trading, they saw this mark, this spot right here as a good spot for a reaction for the market, to go in the opposite direction. So some trading definitely happened right around this area, and went up, to back to the spread, went open back up to 0.1. I mean, whoop-de-doo, but still, there's quite a bit of money to be made in a move like that. And here we are, it's drifting back down. I imagine that it's going to drift back down to touch off of the inversion point again, maybe even drop below it. We'll see, and then it's going to be a matter of, did it close below it on an hourly basis, or did it close below it on a daily basis, or a weekly basis, or a quarterly basis, so on and so on. Actually, while we're at it, let's take a look. Let's look at the quarterly 3-month. Here's the 3-month. Look at that. So it's got it took a dip down below here in July of 2019. Yep, makes sense. There are 2 more days left? Yeah, today and tomorrow left in this quarter. So if I don't really think it matters very much. This steep decline down to zero, whether it closes above or below zero on a quarterly basis, it doesn't matter. This thing is accelerating to the downside. And that's, whether it happens this quarter or next quarter, it's going to happen. So, we'll see. It's definitely, these things, every recession was predicted by, so the, how do I best say this? The inversion, the yield curve inversion has happened 12 times. And there have been 10 recessions following the inversion. So the likelihood of the inversion being a predictor for a recession within 6 to 18 months is really high. Whatever 10 divided by 12 is. 10 divided by 12. There's an 83% chance that the inversion on the yield curve is going to predict a forthcoming recession in the next 6 to 18 months. I think we're a lot closer to that recession than I think 6 months is more. 6 to 12 months is more likely the scenario for the recession than 18 months. So there you have it. I don't know. I mean, what's the market going to do today? And actually, I should do an overlay of this. The stock market reaction doesn't actually happen. The stock market actually doesn't really react to an inverted yield curve until it goes from inverted back up and out of inversion. And this point right here, wherever, I don't know if this is going to be, I don't know if this is going to happen in January of 31. No, that's definitely too long. But what I'm saying is that the stock market actually doesn't start to really see a heavy downward draft until after the yield curve comes out of inversion. So, for example, this is okay. So here's actually a good example for anybody that's been around long enough to remember. So here's the inversion that occurred in January of 2000, and here it is coming out a year later in 2001. In 2001, this climb right here in rates, this is where the stock market, the 2001 dot-com bubble, really started to blow up. And so then again here, we had a long period of inversion. And it started to come out in April of 2007. And then it was 2008. I don't remember if it was early 2008 or late 2008. But this area right in here is where we got the gigantic dump in the 2008 financial crisis, right? And so then, let's see, right here, 99, yeah, this is one of the false. This right here, there wasn't really, in this move right here, back above inversion, there wasn't really that much of a stock market dump or anything. It's really when the yields start to accelerate to the upside after being inverted that we get a stock market reaction. And so then let's go over here. This is 89. Yeah, so here's the recession that we went into, or I'm sorry, the stock market reaction here in the early 90s after coming out of inversion right here in this area. And this run up right here is where we had a dip in the early 90s in the market, in the stock market. So, yeah, you know, be patient. Things are bearish, but the real moves, the real downside moves, usually in the market, in the stock market, usually don't start to occur until after the inversion, after the 10-2 spread starts to come out of inversion. All right, everybody. Yeah, good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.